Hey there, I'm Tony. As a certified public accountant, I know how stressful taxes can make people feel when it comes to investing. And I've spent a lot of time talking to clients about their tax situations. And one misconception that I always hear is that when you reach a certain net worth or complexity in your financial picture, you suddenly have to go hire a tax advisor or some financial advisor to make the tough decisions for you. But as you'll learn today, just because your growing investments might end up generating more tax liabilities, this does not mean you absolutely need to hire some person to hold your hand. At Wealthfront, we've built this platform to be best in class at tax optimization so that you can still be smart about lowering your tax bill, all from the ease of a simple app. The tools we have built are specifically meant to save client taxes while also growing their wealth. So it's really important to understand that those two goals go together. And today, we're going to go over the several ways we help lower your tax bill, including tax loss harvesting, direct indexing, and tax-efficient transfers to and from Wealthfront. We'll even throw in and talk about the Backdoor Roth IRA that can save you money on taxes for retirement. We'll also have chapters listed below, so if you want to go ahead and go right to a specific topic, feel free. Just make sure that you subscribe to our channel, hit the like button first so that you can see more of our content going forward. All right, so let's talk about direct indexing. This strategy replaces the ETF normally used to represent US stocks in your portfolio with the individual stocks themselves. It's offered when you reach $100,000 in your taxable investment account and comes at no extra cost to you. It can enhance and even increase the opportunities for our software to generate harvested losses because instead of just a few ETFs to use, we actually have hundreds of stocks to use instead. So, direct indexing purchases the stocks with the largest market capitalization in the US equity market. So we're talking, Apple, Google, Meta, all those. And to make sure you're fully invested in the US market, we'll also buy completion ETFs that track the companies outside the large cap companies, so you're still getting the proper exposure to those smaller US companies. This allows us to aim for the same returns to the ETF that we normally use for US stocks. But you can't really understand how powerful direct indexing really is until you understand the tax loss harvesting that we use as well. Here's how it works. When an investment in your Wealthfront portfolio declines in value, meaning that it's currently sitting at a loss position, our software can sell that security, recognize the loss, and then reinvest that cash right away in a substantially similar security. This leaves your portfolio with a nearly identical risk structure, so you're still properly diversified. These losses generated by tax loss harvesting can then be used to your benefit to offset taxes, such as capital gains you might generate through selling securities or even ordinary income. We're so proud of this strategy that we even publish our annual results on the blog, something I highly doubt any other service does. Check out the link below to see more. And so with direct indexing, by purchasing the individual stocks in an index instead of just the ETFs, there are many more harvesting opportunities for our software to take advantage because on any given day, there's likely going to be at least a few stocks trading at a loss, right? And even on days where the entire index is up, you might still find stocks to harvest losses with. It simply can maximize the available opportunities to harvest losses. Another benefit worth noting here is it can reduce the fees you pay because individual stocks, unlike ETFs, don't have expense ratios. Let's look at an example of tax loss harvesting with direct indexing. Imagine you have a well-diversified portfolio that includes a share of Coca-Cola, let's say, which you bought for $50. One day, the value of Coca-Cola drops to $49. To harvest this loss, you would sell that share of Coca-Cola for $49 and then harvest a $1 loss in Coca-Cola's value. You could then buy a share of PepsiCo, which is correlated and similar, so your portfolio would still be nicely diversified and still have roughly the same level of risk. Again, you'd end up with a $1 loss to use against your taxable income. Except now, if you're harvesting losses within an index, you should be able to harvest far more losses. Individual stocks are generally much more volatile than index funds. And on a day when an index is up, individual stocks might still be down. And as a result, you can boost your tax savings even further when harvesting within an index instead of versus just the ETF. Direct indexing does this every single day. Now, how can you use your harvested losses? Well, you can apply these to offset short-term capital gains. So these are securities you bought and sold within less than a year. You can apply your harvested losses to offset long-term capital gains. So these are securities you waited more than a year to sell. You can use the losses to reduce your taxable ordinary income by up to $3,000 per year. Or you can carry forward your tax loss to the future years if you don't have any capital gains or income to offset. For comparison, many human financial advisors only do tax loss harvesting at the end of the year, or maybe every quarter or so, if you're even lucky. We look for opportunities daily. Again, our direct indexing is available at no additional cost in taxable investment accounts over $100,000, and we're the only robo-advisor that offers this with tax loss harvesting. If you're interested in direct indexing, here's how you can add it to your portfolio. All right, so to add direct indexing, let's go into your portfolio and let's assume that you have over 100K already in the portfolio. So what you'll do is you'll scroll down to edit portfolio at the bottom, and then you'll click edit investments right here. Because you can already see that you have kind of the classic portfolio. Let's assume you started a few years back, you took that risk score, we assigned you that risk score, and you've stuck with that, right? A lot of our clients have started to want to change the way they invest from here. So we've now given that option to click edit investments. Now from here, you simply have the ability to also change kind of the allocations, but let's assume that you want to add investment. And here you have the list of all the ETFs that you can add, but we'll stick with just the US stocks ETFs, and then we'll click US direct indexing. Direct indexing, right, again, buys those stocks, it replaces that main ETF in most cases with other ETFs. So let's click add to portfolio, just giving you a heads up that instead of investing in VTI, we're gonna invest in direct indexing, and click continue. And what you'll see now is that we're in the direct indexing portfolio. You can even see it up top. Automatically allocated the amount that was invested in VTI now is gonna go to direct indexing. And then what you do is click continue. And then we'll give you a heads up of, hey, we now give you the ability to transition the way that you want to. It auto defaults to tax efficient transition, but you also have the ability to say, hey, I want to transition a little sooner. So what you do is you click update transition preference. And again, it defaults to transition tax efficiently. You can click transition sooner if you don't want to wait for us to actually use future investments or dividends or rebalancing to transition. You'd rather do it sooner. Let's default to tax efficiently and then click update portfolio. And that's it. You're now invested in direct indexing as opposed to VTI. Okay, so we've discussed how Wealthfront can save you money on taxes within your Wealthfront investments. But did you know Wealthfront can save you money on taxes when you move your outside investments to us as well? So one of the biggest issues with moving investments from one brokerage to another is the tax hit that you might face when that receiving company receives those securities. We built a product that actually works to minimize your tax hit or even avoid it whatsoever so that you don't have to worry about this. In general, you can transfer most US stocks, ETFs, and mutual funds quickly and easily through our automated transfer process. Simply after linking your external account, our software will review your portfolio and show you which investments you can transfer to Wealthfront. Let's go through some of the different scenarios for transferring investments to Wealthfront. Number one, when you transfer investments we support from an outside brokerage, if the allocation you have chosen for your Wealthfront portfolio approximately matches the investments you plan to transfer. Basically, no more than 2% variance from your proposed allocation. Then we will incorporate the transferred securities without selling. This means you typically won't incur taxes as a result of the transfer. If your transferred securities do not really match your chosen Wealthfront allocation, then we will sell the excess, which therefore might incur taxes, sure. However, we may delay these sales until your short-term gains become long-term gains, which means you've held the security for at least 1 year. Long-term capital gains are taxed at a lower rate than short-term capital gains, and therefore lead to a much lower tax bill. If you have investments that are held at a significant gain position, but you don't want to sell them, this means you can transfer them to Wealthfront and then potentially avoid a huge tax hit. Now, it's nearly impossible to completely avoid taxes forever. So sure, we may have to sell some securities at a gain to incorporate your portfolio into its target allocation. But if we do this, our software will attempt to hang on to these securities if you've held them for less than a year, so your tax hit might be at the lower long-term capital gains rate. This can be massive now and later in the future. Number two, when you transfer investments we don't support from an outside brokerage. Securities we do not support will be sold immediately if they won't incur a negative tax hit, meaning that they're trading at a loss, no gain, or a long-term gain. If they're trading at a short-term gain, they may be held until they qualify for long-term gain treatment, which is just 1 year after they were purchased. One thing to note here, we will sell all mutual funds immediately, regardless of whether they're trading at a loss or a gain. We can't yet hold these in Wealthfront portfolios, and we can't migrate these tax efficiently, so we just have to get rid of it. Number three, transferring individual stocks to Wealthfront accounts with US direct indexing. So if you have individual stocks you want to transfer to Wealthfront and have over 100K in your taxable investment account, we might even be able to incorporate as many of your US stocks into your portfolio as we can through US direct indexing. Direct indexing replaces the ETFs representing the US stock portion of your portfolio with individual stocks and then a few extra ETFs to round out your allocation to the whole asset class. For most account sizes, this just means we'll likely buy the 100 or so largest publicly traded stocks in the US and then use a few other ETFs to round out your full US exposure. We recommend that you add US direct indexing to your portfolio before you initiate this transfer. So basically, if you hold stocks that we also might use in direct indexing, we may just be able to incorporate those in without even needing to buy or sell anything. Those stocks will then get to participate into our fully automated tax loss harvesting. And if your account is under 100K and that transfer won't get you above that threshold, we won't be able to incorporate those stocks until you reach that level. We'll simply hold on to those stocks until they're at a long-term gain or a loss before selling them. You can read more about how we tax efficiently transfer your securities in the description below. Number 4, transferring shares from your employee stock plan or equity held in a publicly traded company. First off, you absolutely need to confirm that you are eligible to transfer your shares out of the stock plan, so you have to ask your plan administrator before you do anything. If you aren't eligible, you have to leave them there. If you are eligible, but are still an active employee, you'll then have to ask your company's HR department if you're subject to any stock trading or blackout period restrictions. If so, you cannot move these shares to Wealthfront until any restrictions are lifted. It's such a hassle in this case that it's probably not worth, kind of messing with this at any point. If you're no longer an active employee and eligible to transfer your shares out of the plan, you can likely transfer the shares to Wealthfront. You just want to reach out to that brokerage that holds the stock plan to make sure these shares are in an ACAT eligible brokerage account. This just ensures that the transfer will go through smoothly. Once you've confirmed all of this, you can then transfer the account as you would any other brokerage account, and we'll handle them in the same manner as discussed below. If you're above 100K in the taxable account and they're a part of direct indexing, we'll try to migrate those in without selling. If you're above 100K but we don't use those securities in the direct indexing portfolio, or just under 100K overall, we'll attempt to sell them tax efficiently. The only reason we wouldn't already use these stocks would be simply due to the small size of the company, as direct indexing is only the 100 or so largest stocks publicly traded in the US. And lastly, let's talk about the Backdoor Roth IRA. The Backdoor Roth IRA can help with taxes when saving for retirement. So in addition to offering traditional Roth and SEP IRAs, one thing I want to highlight is how easy it is to do this and use the Backdoor Roth IRA conversion within Wealthfront. If you don't know what this means, a Backdoor Roth conversion is done by contributing a non-deductible amount to a traditional IRA and then immediately converting those funds into a Roth IRA. Why would you do this? Well, if you're over the income limit to contribute to a Roth IRA, the IRS still allows you to take advantage of the Roth IRA through this backdoor route. So funds in the Roth IRA then get to grow tax-free and don't incur taxes upon distribution when used after 59.5 for retirement. All right, so I'd be willing to bet you didn't know there were so many ways just within investing to help minimize taxes. Maybe you don't need that tax planner or human financial advisor after all. Hope this video was helpful in understanding the different ways that Wealthfront can optimize and save you taxes now and down the road, simply just through your investments. We're gonna throw a lot of links down below in the description because we talked about a lot today. Feel free to hit like, subscribe, comment. Let us know what else you want to hear. I'm Tony from Wealthfront. Have a good day.